Hey guys and gals, March has come and gone, so it's time we share our Tfsa dividend income for this month. Let's do this! As usual, before I jump into who paid us and how much, let's glance at our portfolio's dividend calendar. January, April, July, and October are the bigger months, and February, May, August, and November are the smaller months. The other months land somewhere in the middle. In March, we received dividends from the following 8 stocks. Like usual, we'll go through each paycheck we received, adding up our totals along the way, starting with the smallest payer, not paycheck. Don't forget to smash that like button if this video is for you, and subscribe if you want to follow our TFSA portfolio journey. You all have made it clear that you love our custom charts, and we are so happy that we add a little bit of value to help you invest. I'm planning on making the charts even more detailed to help you in your investing journey. Just comment below with what you'd like to see in them. Now for our first paycheck, our smallest dividend payment of $23 was from our one closed-ended investment fund, Canoe EIT Income Fund. It provides us with 3.8% of our yearly dividend income. EIT has consistently paid out 10 cents a month for 2 decades. With a yield on cost of over 11%, this has been a nice little cash boost each month. Next, our OG utility Fortis paid us $66.11 in December, and this month, $70.63, a nice little gain because of the dividend increase. This gives it a weighting of 4% of our yearly dividend income. Fortis has been a stable and steady grower over the years, with a price growth and dividend growth both around the 6% mark. Right now it is yielding 3.9%, which is 8% above its 5-year average yield of 3.9%. The stock price ended the month up almost 8%. At this price level, I should turn off the drip. I'll wait until the last minute to make that call. I do get a 2% drip discount, which does help a little. After our first 2 paychecks, we're at $93.63. It's so cool, many of you are following us on Blossom Social now. We actually have more followers on Blossom than on YouTube. It's been crazy. With Blossom, you get to see all of our trades in real time, as well as some of our thoughts on the market. All you have to do is click the link in the description below to download it for free. That's my favorite price. Now for our third, we were paid $79.94 in dividends from Manulife Financial Corporation. Last quarter, it was $72.27. That was purely organic dividend growth. Gotta love that 10.6% dividend increase. MSC provides us with about 4.5% of our annual dividend income. This has been a core holding in our portfolio for a long time. They continue to grow their dividends at a rate of 10% over the past 5 years. It is currently trading at a PE of 6.7 and a yield of 5.9%. I don't see the dividend raises stopping, as this still has a payout of only 40%. The share price really pulled back after that global banking crisis at the beginning of March. Since then, things have stabilized and it's climbing back up again. After 3 paychecks, we jump into triple digits at $173.57. Our next dividend received was $107.01 from our new quarterly payer, Pembina Pipeline Corp. It pays us 6% of our yearly dividend income as one of 3 in the oil and gas midstream pipeline industry. You may have noticed this is a much higher payment than usual. That is because PPL moved to a quarterly payment. Pembina Pipeline is trading at its 5-year average yield of 6% after the whipsaw in price. It recently raised its dividend 3.6%. It has a 4.6% 5-year CAGR on its dividend. It is trading down 4% on the month, but did drop 10% from peak to trough in the month. Pembina Pipeline as a toll booth is well positioned for continued growth in Western Canada, despite crude prices being under pressure all month. With this paycheck, we are at $280.58. Our second pipeline to pay us this month was Enbridge. They provided us with $131.55 in dividends, up 5% from last quarter, and now represent 7.3% of our annual dividend income. The stock was very flat all month and didn't swing as much as Pembina. With its 3.2% dividend increase, it is now trading with a yield of 7%, while its 5-year average is 6.6%. So it has a small discount based on that. We have a decent yield on book of 7.6%. I'm hopeful Enbridge can raise its dividends closer in line to its 5-year average CAGR of 7.3%. That will require some good growth of cash flow from its current pipeline of projects. Get it? Pipeline? After this big dividend, we hit $412.13. Next, we were paid $46.68 in distributions from SmartCentres Real Estate Investment Trust. They now provide us with 8% of our forward annual dividend income. They're trading above their 5-year average yield of 6.2% at a yield of 7%. SmartCentres is down 4% on the month. Real estate is really under pressure because of the world banking crisis. I would be worried about holding office space right now. Diversified retail REITs should be much safer in my opinion. SmartCentres has a 5-year dividend growth rate of 1.6%, almost matching inflation, but has not increased dividends since 2019. I don't see a raise in the near future either, not until some of these densification projects are completed. With this monthly distribution, we're at $458.81. For our 7th paycheck, we have our one monthly financial payer, First National Financial. We receive $50.40. FN provides us with 8.4% of our annual dividend income. It is down 5% on the month due to the banking crisis. Currently, it provides a 6.3% yield. With a 5-year average yield of 5.8%, this is trading much below its average. By PE ratio, it remains on the expensive side. First National Financial had a small 2.1% dividend increase last year. That makes it 11 years of dividend increases and a 5-year dividend growth rate of 5.3% to go along with a very healthy 7.7% 5-year CAGR on its stock price. I anticipate another dividend increase this year with its healthy payout ratio of 74%. With that monthly dividend, we get to $509.21. And lastly, the Goliath of our portfolio, RioCan Real Estate Investment Trust. They paid us a distribution of $64.80 this month. This company provides us with a massive 10.8% of our forward yearly dividend income. It has a 5-year average dividend yield of 5.8%, which is 10% higher than the current yield of 5.3%. This is mainly due to RioCan slashing the dividend by 33% back in 2021, during the pandemic. RioCan has now raised its dividend 2 years in a row. In spite of that, it still has a negative 4.5% 5-year CAGR on its dividend. It'll take a while to get that back to 0%. In the meantime, this provides huge potential in the RE space for us, with a payout ratio of only 59% by funds from operations. So after all 8 paychecks on the month, our grand total is $574.01. Our top 3 dividend payments accounted for $318.50, or 55% of our dividend income for the month of March. With Pembina Pipeline now a quarterly payer, March, June, September, and December, we'll have a bit higher paychecks and the other months a little less. We're not too worried about payout months. We focus on the portfolio quality and never want to be too dependent on any one company to help the portfolio grow in the event of a dividend cut. As you can see from the breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. We had 4 dividend increases in February. This month, we had 0. There were some notable dividend increases for old positions and some on our watch list. Here's some of them. Dollarama had a massive 28% increase, bringing its streak to 12 years. Anghouse Systems had a good 18.9% increase, bringing its streak to 16 years. Stella Jones, not the drink, had a 15% increase, bringing its streak to 18 years. Premium Brand Holdings had a 10% increase, bringing its streak to a decade. Power Corporation had a 6.1% increase, bringing its streak to 8 years. Canadian Natural Resources had a 5.9% increase, bringing its streak to 22 years. And lastly, Maple Leaf Foods had a 5% increase, bringing its streak to 8 years. Our forward annual dividend income is sitting at $7,178, down about 19% from last year, with a yield on cost of 7.36%. We have a lot of cash to deploy this year and have just started. We expect our dividend income to snowball faster as we do. Those that follow our channel know that we see our dividends as our little minions that work hard for us while we sleep. With our minions working harder and harder each year, we can forecast where we'll be in about 10 years. We hope to outpace this forecast as the TFSA Contribution Room grows in the future. Thank you so much for watching, liking, and subscribing. Until next time, I'm Mr. Financial.